Devina Mehra joins us. Let's connect with her and get a sense of markets, valuations, and sectors. Devina, good morning. Thank you for joining us. This comeback in the market has surprised everybody. From where we were in a turbulent March versus where we are in terms of May, benchmark indices have made a roaring comeback. Are you a bit surprised with this comeback in the market from the lows of March to the highs of May?
My view on a 1-2 year basis has always been positive on the market, especially on the non-frothy end of it. So that's what I said last time also I was there. Yes, we were expecting a little bit of volatility, which we have seen. We are still a bit cautious on the very short term in terms of possible volatility. So we are hedged on our portfolios. On our PMS, we are hedged. So that is still the case. But as I said, we don't see any risk of a big crash. We are fairly positive in the medium term. So we have not made any cash calls. So, I mean, we are where we want to be.
The longest time we've used Fed as a benchmark to judge liquidity, to judge the mood of equities. And frankly, if I look at last 6 to 8 months, whatever Fed has said, it is not having an impact on the market. First they said we will cut rates. Now they're saying we may not cut rates. Markets are saying doesn't matter what Fed is doing, we will do our own bit. Isn't it amazing? I mean, Fed is getting more and more irrelevant, and that used to occupy all the center stage.
Well, my view, which I have tweeted also in the past, is that the same set of circumstances you can use to explain whether the market is going up or down. So if rates are not getting cut, you can say economic growth is so good that the rates are not getting cut, and therefore the market is going up. If the market was going up when the rates were getting cut, you would say the rates are the driver. So the same thing, you can look at it both ways. You can use it to explain the market going up or down. So the stories always follow what's happening in the market. And there's this good book called Everything is Obvious Once You Know the Answer. So depending on what is happening, you can always retrofit what is happening. In terms of the Fed itself, the rate cuts, I have never been in that camp which said that rate cuts would happen in a hurry. If you go back to 2023 beginning, at that time, the consensus was that in the second half, rates would be cut. And I said, that's not going to happen. 2024 beginning, the consensus was that March itself, rate cuts would start. Again, I was not in that camp because the coming down of inflation is a very slow grind. It doesn't happen in a hurry. It doesn't happen in months. It doesn't happen in quarters. And right now, Fed is doing a bit of a balancing act. I mean, they are saying we are not driven by election year, but the fact that they have slowed down on the quantitative tightening, that while they're not cutting rates, they're still somewhat dovish. So that I think is also there's an overhang of election year everywhere.
Sure. Devina, is it as obvious, or is it going to be only foresight as to what our own elections would imply for the markets right now? Or do you think right now is a little early perhaps to try and pencil in what the market thinking is?
I think the market thinking and the whole consensus thinking is the same. I don't think people are expecting any surprises. So, I mean, by definition. But as I said, our systems, whether it's election-driven, geopolitical-driven, whatever, are seeing possible volatility for another month or two. That is possible. But, we spend a lot of time thinking what impact will the elections have. And if you go back 20 years to 2004, which was an absolute surprise, you had the sitting government so confident that they preponed the election, they advanced the elections by 6 months, and then almost the entire cabinet lost. So it was a complete surprise. And the market crashed on the day, if I'm not mistaken. The market itself was circuit down and the trading was halted. But it recovered in no time, and that 1 year was one of the best years ever in market history. So I think we spend too much time and effort trying to predict election results, and the market has its own mind, and it may not even mind a surprise at the end of it as we saw 20 years ago. But I don't think that's happening.
Morning. For the most part, majority of the commodities have been on an upswing of late. How are you reading into this?
Yeah, I mean, if I look at what we have done in the Indian markets, yes, we have added a few commodity stocks in our last rebalance, in fact, little before our last rebalance itself. So some amount of metal, steel, etc., and even some cement, but we are not heavily overweight or anything. In terms of the precious metals, our bet in our multi-asset portfolios, both in India and globally, has been to add a bit of silver. Again, these are not big bets, but we think, silver is looking better than gold now. So we've added a bit of silver. Uh, we don't see a very huge commodity upcycle in terms of either the quantum of the move or the length of the move. But right now, yes, as you said, that there has been somewhat of an uptake.
Even in the last whole 2 years has been about, the K-shaped recovery in the market, premiumization coming stronger. But just looking at Dabur's numbers yesterday and what the rural growth actually entails, from -5%, it's jumped to now 6%. Their rural sales, that is. You think it's now time to start betting in on a rural recovery play out? Because, these are some of the exposed sectors which have also been most under-owned, completely ignored, much like what's happening with IT right now.
Well, I haven't seen the Dabar's commentary or the details, but if you're saying it was down 5% and then it's up 6%, so all you're saying is that it is back to where it was 2 years ago, which is not saying much. And I mean, I think that that part we cannot ignore completely, that there has been a big disconnect in what's happening in different segments of the market. I was reading Rama Bijapurkar's book, Lilliput Land. And to me, what stood out the most is that the bottom 60% of India now has no surplus at all. Income minus, not, not even taking one-time expenditure, but routine expenditure, they are negative. And there's been an absolute decline in their incomes from about, I think, 2016 or so, FY16 onwards. There's been a downward slope for the bottom 60%, most of all for the bottom 20%. So their incomes have gone down in absolute terms. So those things are still an overarching thing. Yes, from beaten down levels, sometimes you will see that growth. But if you look at the GDP number, also consumption growth was last I saw was sub 3%. Last it was that low was 2002-3. So those are still concerns. Employment is still a concern, and employment and consumption are actually quite linked. So yes, I mean, from beaten down level, something might perform and you will see revenue, you might see stock performance. But I think overall, that whole thing that the recovery is K-shaped, that story is not changed that much to my mind, whatever data I've seen.
Okay. Devina, the general consensus was that small cap is where the bubble and trouble is. Large cap is where the margin of safety was. And that's really been the street view for the longest time. But in this market correction, mid-cap, small caps, first they fell hard. They were due for a fall. But they've also come back with a gusto. My question is that are you a bit surprised with, as a cluster, the price action in mid and small cap stocks that continue to surprise us? For the holders, it's a delight, and for the non-holders, it's a surprise.
So, any kind of correction, obviously, I mean, you get these false bounces before anything big happens. Also, remember now, the definitions of small and mid caps are now number of stocks based, the top 100 stocks and 250 stocks like that. So actually what is now classified as mid cap, for instance, would have been large cap not so long ago. So the way we look at it is that, because we are looking at it from the risk management perspective rather than the paper perspective. So we are very careful with anything below 5,000 crore market cap. We don't look at anything below 1,000 crore market cap. Below 5,000 also we are careful, because those kind of stocks, and because simply because we always prioritize risk management first, because only if you don't lose do you win. This is the basic principle in the market. It's a loser's game. Investing is a loser's game. So the problem with the very small stocks is that unlike large caps, you cannot have a proper risk management system either. If you put a stop loss, you might never get a chance to exit that stock. When they fall, they can go all the way down without your getting an exit. Many of them just disappear. This is also, you would see that only about 4,000 4,100 companies are traded in the Indian market. The number of listings, if you add it up, all the IPOs historically, was several times that. So all those many companies are nowhere to be seen. The small cap index itself churns 20% a year, 18 to 20%. So in 4 or 5 years, it's a completely different index. So all those things also have to be kept in mind. And as I always say that don't forget your school arithmetic. So in 2000, let's not even go to 2008-9, even in 18-19, the small cap index fell nearly 2/3. So even if it triples from there, you are at zero. So those things have to be kept in mind. So I mean, basically, we limit our exposure below 5,000 crore market cap quite severely, even if things look good. And so you be careful on that end of the market. You need not avoid it completely, but where you are buying and how much of your portfolio is there, that's where you have to be careful.
Divide the market into what is the consensus trade and what is the non-consensus trade. The consensus trade is capital goods, defense, machinery, energy. That's the consensus trade. The non-consensus trade, I guess, is consumer staples and IT to some extent. Now it's getting on the wrong side of the trade. Where are you picking your spots? Would you like to be with the consensus in the market, which is energy, power, manufacturing, or it is time now to look at non-consensus, a bit of IT, a bit of consumer staples?
So capital goods industrial is now the consensus trade. We went overweight on it in 2021, October 2021. At that time, everybody thought it was a dark sector. It took the market another 2 years to discover it. So the question we ask every quarter right now is that story over? Because that has given us great return. Stocks have doubled, tripled, even quadrupled. And we've been cutting exposure. We've been changing the stocks, but we are still, we're not as, we don't hold as much as we used to, but we still are overweight. But that story may well get over in some quarters. And on the other hand, I mean, the stocks that the other things which we still like are auto, pharma, some construction. On the other side, yes, IT, I think, is somewhere, while we are not hugely overweight or anything there, but that's the one that we are watching for a bottoming out. I think sometime this year, that will be the big opportunity.
So speaking with you, Devina, thank you for joining in and sharing with us your thoughts and view on the markets as a whole.
If you like this video, then like, share and subscribe to ET Now.